Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenevec on Bloomberg Radio.
As we mentioned, we are bringing you the latest on everything when it comes to the tragedy of this 787 Dreamliner operated by Air India that crashed, helping turn 2025 into one of the deadliest years in the past decade for civil aviation. Right now, Sean Duffy, the transportation secretary, is giving a press conference. Much of the press conference not focused on this crash, but a couple headlines emerging. The transportation secretary saying that they're deploying the FAA and NTSB teams on Air India crash, though India will lead the investigation and the U.S. will assist.
All right, so let's get more on all of this. Joining us right now from, excuse me, I'm a little confused.
London.
We are going to go to London.
Yeah, let's go to London and go to George Ferguson. He's senior aerospace and defense and airlines analyst for Bloomberg Intelligence. He joins us from London. George, I want to get, you've been flying actually today. When we heard from you earlier on Bloomberg, I heard that you were in, was it Oslo earlier in the day? This is all setting up. Yeah, all setting up for you to, I think, do some European work in the coming weeks. George, we're hearing from Sean Duffy that India will lead this investigation. The U.S. will assist. Is this typically how it works when it comes to how the FAA investigates?
I think it is pretty standard. I think the FAA obviously gets involved because it's a U.S. built aircraft, but typically I think they let the nation, that's the airline operates and lead the investigation.
Okay, so let's talk a little bit about what we've been able to glean just in the few hours since this tragedy. I want to talk about just the process of determining what happens here. And I think when you hear Boeing and you hear plane crash, unfortunately, a lot of people's minds turn to what happened with the 737 MAX and the disasters that were truly a result of, I guess we could call it a manufacturing defect, a software defect that led to a long time grounding of these airplanes. Given the history of the 787, what's the right way to think about this tragedy?
Yeah, I think that we don't have, and we don't know for sure, right? But I think most of the signs point to the fact that we don't have that kind of problem here, a systemic manufacturing problem. I mean, one of the things I look at is this airplane was in fleets for 11 years. That's a pretty long time to be flying. It's gone through some level of maintenance at Air India at this point. And the way the airplane crashed, it was in somewhat controlled flight, but looked like it couldn't get altitude. Typically on takeoff, when an aircraft can't get altitude, there's some sort of problem with the engines. Those are GE engines on Air India's fleet. Again, 11-year-old engine would have been maintained since it left GE's factories. So I'm wondering if it's either some level of maintenance or conditions there in the area today.
George, because of that, both Tim and I were, listening to you earlier. I believe it was on Bloomberg Surveillance, and really kind of breaking it down and just saying that, you look at the video and it seemed like everything was okay until it wasn't. So you bring up the maintenance issue. How quickly do they figure something like that out?
So I would imagine that it's not going to be hard to find the recorders in this jet, and so that ought to give them some sign as to where different throttle positions were and how much thrust the engine was producing. So I'd imagine, in fairly short order, they could probably get at least a sense for that, which I think is going to start to point them the right direction in the investigation. My guess is you're talking a couple of weeks, not extended periods of time.
We did speak with Julie Johnson a little earlier, and she reminded us that there is this sort of checkered past when it comes to this plane, which includes some manufacturing issues just a few years ago. But before that, the battery issues, and before that, with the earliest planes, there was the sort of retrofitting that she talked about. To you, George, does it make sense to be talking about that in this context, or has the track record of the 787 essentially proven that it's not something that has to do with the defect of the plane.
Yeah, to me, again, the track record does indicate, I think that the airplanes have been performing fine. For sure, I mean, some of the latest challenges we had in the airplane was joining of the fuselage pieces together. But again, what we saw was an airplane that was very much intact. It just looked like it couldn't develop enough lift. And so I'm just thinking it isn't, some of those defects that we're thinking there was no fire that the battery box issue would suggest if you're having that would be going on. So it just seems like, again, it was just too stable. It was just too stable and really, again, looked like an airplane that couldn't develop enough lift. And so to me, the first place I'd be looking, I imagine investigators will too, will be to see how the engines were performing at that moment.
Well, you mentioned engines, right? I'm looking at shares of GE, George. They were down about 2.25% today. Boeing was down about 4.8% today. It's just one day trade, and obviously it's not surprising to see that kind of reaction. Before we go back to GE, I want to ask you about Boeing as we get ready for the air show, the Paris Air Show. And I just wonder, is it just... Boeing's just had such a tough time, and it felt like they were just kind of getting back on track. Tim and I were in a 737 MAX, and it's a really nice plane. And
everything seemed brand new.
Everything. It was just hard not to be impressed with it. Is this a problem for Boeing, or it's not just, especially if it turns out to be something like a maintenance issue? Because it just seems like everybody's like, another thing in the air, another thing with Boeing.
Yeah, I do get the sense, like you said, that there's a lot of concern. Boeing has had quality issues. The questions are, is this a manifestation of another quality issue or something we don't know at Boeing? Again, from everything I've seen so far, I would tend to think it isn't a Boeing quality issue. We never like to see airplane crashes. And for sure, Boeing's had its challenges, but Airbus does get them from time to time.
Yeah.
But everything I'm seeing don't lead me to believe that it's a Boeing quality issue. And I wouldn't even think potentially a GE issue. I think it was in the field so long that it's probably not a GE issue.
Will it bother either of them at the air show? I mean, often we get orders out of these shows. Do you think any of this is going to color any of that or change any of that?
I think unless we would hear very shortly that, again, it was a problem with some of their manufacturing.
Yeah.
No. 787 is one of the airplanes. I think that you'll see a lot of competition around 787 and A350. Both of the manufacturers, those are two competing products that they would like to increase production rates for. I suspect supply chains could probably boost to higher build rates in the near future on it. So we're kind of watching that competition at Paris Air Show. I think that could be some of the source of orders for both Airbus and Boeing, the A350 and 787.
George, in the story, the Bloomberg News story about this tragedy, it includes information about who was commanding the aircraft and who the first officer was. The commander of the aircraft, 8,200 flying hours, and then 1,100 flying hours for the first officer. 8,200 flying hours, that is a long career when it comes to any type of aviation.
Yeah. Yeah. I mean, it doesn't seem like...
That's serious experience.
Yeah.
Yeah. It wasn't an experience. I mean, it seemed like the captain had a bunch of time. So, yeah. I sometimes, things... I'm a Dita bot. I'm not doing a great job of pronouncing it, I'm sure. From what I understand, is a hot and high city. And so remember that airplanes also have to work harder. Engines have to work harder to get airplanes out of those kind of cities. So I'm wondering that if that is probably part of the problem here, where the engines were just worked really, really hard, and maybe something went wrong in the engine that just wouldn't allow it to produce full lift and get out of there.
Do we know, is this kind of a newer route? I thought I had seen Air India had recently opened this up, but I may have read that incorrectly. But is this a route that's been taken often?
Yeah, not sure about that. For sure, I've heard of flights in and out of the city. And some cities you just have to sort of manage around temperatures and how much you fill the airplane, how much fuel you put on, how many passengers, how much cargo. but
Yeah.
I'm not sure if it's a new route.
Hey, listen, because you are over there in London, I'm assuming, I don't know, are you headed to the Paris Air Show?
I am.
Tell us what's
Via
kind of,
London.
we always love checking in with you. And obviously this is a difficult story, a tragic story, and a story of human lives that are lost. But in our last minute, curious about kind of what's top of mind as that show gets underway.
Yeah, and so we're going to put a report out tomorrow on the Bloomberg terminal. But I think, we don't see a lot of orders coming out of the show this year. I think tariffs are probably going to be the dampening factor. I think
Wow.
everyone wants to figure out what the effects tariff have on their aircraft deliveries. We're watching deliveries, seen recent deliveries, last month's deliveries for Airbus and Boeing. Airbus had a few into the US, but less than usual. Boeing had really none into Europe, where I think they're both experiencing tariffs. So I think that kind of
Well,
puts a gray sky over lovely Paris.
just in the last 30 seconds that we have with you, it seems like Boeing is starting to be used as a bargaining chip to its advantage when it comes to the way that the president is negotiating these things. What's your view on that?
Yeah, we're expecting more of that. And I think that's one of the reasons Boeing probably has the best potential for more orders. Orders have been light in the last couple of years. I think as Boeing's customers watch build rates and look for confidence that Boeing is getting that production act together. Boeing is starting to show that. So we think this year could probably be pretty good. And we think the president's going to probably try to use it to balance trade with partners that might be, in his words, offsides on trade. So could be a good year for sales for Boeing. I'm not sure it's going to come through at the show, but we're looking for a pretty good year for sales.
Yeah, and you can see investor sentiment has certainly been much more optimistic on Boeing. That stock's up about 15% year to date, and that's even with a more than 4.8% drop in today's session. George, thanks. We know it's later over by you, and we're glad we could touch base with you. Busy day, and I know you've got a busy week ahead. George Ferguson, Senior Aerospace, Defense, and Airlines Analyst, our go-to on all things when it comes to airlines and aerospace, of course, here at our Bloomberg Intelligence team, joining us from London.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Do want to point out the U.S. dollar did fall to its lowest in 3 years on that PPI data, while at the same time President Trump's tariff threats revived concerns over U.S. economic outlook. So together with jobless claims jumping to the highest since the end of 2021, although Mike just gave us some great perspective on that, the data pushed traders to add to bets that the Fed might be a little bit more aggressive this year.
Yeah, with a look at how FX and pressure on the U.S. dollar, we've got Jayati Bardwaj joining us, Director in FX and EM Strategy at TD Securities. She joined us here in the Bloomberg Businessweek studio. JT, welcome. Good to have you. I want to start with the weak dollar. As Carol mentioned, I mean, we're seeing weakness that we haven't seen in years here in the U.S. Big picture, what is the signal that sends about the faith of the U.S. economy and the way that investors, both here in the U.S. and internationally, are thinking about the U.S. right now?
Thank you so much for having me. I think definitely the move in FX has been very interesting because we've seen yields go back up higher. Even equities have tried to go back higher to pre-Trump levels, but the dollar has just been collapsing. Nothing gets the dollar to rally. Strong U.S. data, hawkish Fed, tariff threats, geopolitical uncertainty rising. Nothing is, fueling any strength in the dollar. I think what this is indicating is probably a shift in global investor preferences. For the last 5 years, people have been long U.S. assets. And interestingly, they have been long U.S. assets unhedged because you could also, always rely on a very strong dollar return to get a nice boost to your portfolio. But that's not happening anymore. And from the data we have, we do see that investors are finally starting to change their hedging practices. They are now waking up to the fact that they cannot no longer rely on the dollar just coming back to its strong raging days, and they actually need to hedge that exposure. In order to do that, you need to be selling dollars in forward markets, which is likely what's structurally keeping the dollar so weak right now.
So that's the difference, the hedging that we're seeing that we haven't seen for a long time, where the U.S. was kind of Tina, right? The only, it just seemed like all investors wanted to be in US dollar-based investments. So what we're seeing now is hedging, and that's making an impact.
Yes.
Is it a sign too? I mean, do you go as far, JT, that it's the idea that the U.S. is uninvestable? Tim and I like to ask this question because, yeah, it's a great headline, but it's more important. It would be a very different mind frame, investing mind frame.
I think that's the one question that we've been trying to answer. The gap
the 30-year
between
Treasury auction just went well.
Yes.
So investors
People
still
saw that as
interested.
investable.
Yeah, exactly.
So I would say the gap between the US and the rest of the world has been extremely wide for the last 5 years. I wouldn't say it has been completely bridged to zero, but the gap is definitely meaningfully shrinking enough from both sides. The US, thanks to its own policies, but the one silver lining from all of this is that it's actually forcing other countries to introspect. They're now looking at more fiscal spending domestically. They're actually also looking at cutting intra-regional trade, trade barriers. They're also talking amongst each other to, have stronger intra-regional trading relationships. So that all is actually making the rest of the world more investable. I wouldn't say that the US has completely, given up its crown position. But I would definitely say that a lot more investable places are now coming up to the surface where they had been very underground for the last 5 years.
So is it, forgive me, Tim.
Well, is it about them being underground and becoming above ground in recent years? Or is it about risks that investors see to the U.S. in your view?
Great question.
I think it's both coming together at the same time. And you could say the source is the same, right? Because the U.S., thanks to its own policies, is actually now forcing the rest of the world to step up. The European Union is taking a much more proactive approach to talks with Russia, Ukraine, something they have not done.
Right.
The world realizes they can no longer just, solely rely on the US for everything. And they are being forced to step up and actually do a lot more themselves.
Well, just to push even further, I mean, and Tim knows I've asked this a lot coming off of Milken, which was back in May last month. But the whole idea and what we kept hearing from a lot of folks was that it's not the case of the U.S. being uninvestable. It's just that investors became overbalanced in their portfolio, overexposed, I should say, to U.S. dollar-based investments. And so now they're, reallocating and rebalancing. But it almost felt like, wait a minute, is that just an excuse to kind of cover the idea that people are turning away from the U.S. and not so comfortable with the U.S. and risk? And that's what. So tie that in also, if you would.
So for the last 5 years, the US has been relying on the kindness of strangers because all the global portfolio managers and the savers of the world in Europe and Asia, they all had been piling money into the US. You had the chase for carry, you had the commodity shock where the US was energy independent, and you had an exceptionally strong and growing US. So all the three factors which were driving investment in global markets resided in the US with the US. So everything was a US investment. US equity investment has ballooned. In fact, foreigner investment holding of US equities as a share of market cap has also been going higher. That also actually led to a very strong and overvalued dollar. So the overvalued dollar went hand in hand with very strong portfolio investment into the US. And that's why both of them are being questioned at the same time. The dollar as a diversifier, as a safe haven, we see those correlations are breaking down. The dollar actually, on some days, I actually think is trading a lot more like an emerging market than it is like a safe haven, unfortunately.
So wait a minute. So net, is this better for the global investment environment in the long term? Is this not so great for the U.S. investment market? Is it also all the result of President Trump?
I think net, it's a healthy recalibration of markets. Like the last 5 years, we've all come to points where we're like, is the U.S. markets, are they overvalued? Are they bubbled up? Are valuations expensive? I think this was a very healthy recalibration that was needed. For the last many years, most markets have been a pure dollar beta. What are U.S. rates doing? What are U.S. equities doing? What is the U.S. dollar doing? But I think this levels the playing field a little bit now, which is healthy, I think.
Is it the result of President Trump and his policies?
I think it is definitely. It is. One source is the policies of the current administration and just the volatility associated with it. The one interesting thing in all of this is that while the U.S. is trying to negotiate with 90 countries in 90 days, those other countries have only one country to negotiate with. So that is also one factor which is equating the U.S. with the rest of the world at this point.
Just about 45 seconds left. I know emerging markets and FX is what you focus on. Is Bitcoin on your radar at all in that context?
We prefer not to comment on Bitcoin. That's not under our purview of coverage. But I would say that when people are talking about the safety of U.S. assets, things like gold, cryptocurrencies, they do come up a lot more than they usually have. My answer is that while I cannot comment on cryptocurrency, I can say that you can potentially look for other alternative safe havens in FX. That is Euro. Euro is clearly shining out as one of those, the Japanese yen. We do see scope for them to see more upside this year. In fact, one currency, or one sector of currencies where you can see a good upside is Asia and Aussie. Which is something which is not talked about a lot, but I just wanted to leave it at that. That's something which could see big gains at the end of the year.
Jayati Bardwaj, thank you so much. Really appreciate it. Over at TD Securities.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the drive to the close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. Just about 18 minutes to go until we wrap up the trading day.
Did you have a bachelorette party, Carol Messer?
I didn't really.
Yeah.
We had a shower. I had a big shower.
I had no bachelor party.
Really?
Yeah.
No?
No, it was a busy time.
Like not even a bunch of you dudes taking a biking ride
That's
somewhere?
what I wanted to do that, but it didn't. I wanted to do it with my brothers, and my brother had just had a kid, like a brand new kid. So I was like, we can't really make
brand
this
new
work.
kid versus an old
Yeah.
kid? Hey, I just had a 19-year-old.
Well, like he couldn't really leave.
I totally get it.
But anyway.
Yeah, I know. Okay.
We're off topic here.
I know. Well, it's just that kind of a thing. Let's talk about the markets because there's a lot coming at us. Let's get to it. Eric Weiner, special guest for us, senior editor, Equities Americas at Bloomberg News. Love having him at this time. He's right here in our Bloomberg Interactive Brokers studio. Markets aren't, they're up, Eric, but it's not like massive gains. And yet there's so much going on behind us.
Yesterday was the big shock. After the CPI print came in so nicely, we assumed that we'd get to the record on the S&P 500, and instead we ended up down. Today, producer prices came in also looking good, and we're up a little bit.
Yeah.
It's basically like the most unloved rally we've seen in a while.
Okay, I think it's telling that
Enter
Carol and
Mr. Context Guy.
I think there's something telling here. No, you know what? I'm not going to do it. I'm not going to do it.
Oh, come
what
on.
I'm going to do is I'm going to say we've spent the last 1 hour and 43 minutes not talking about a U.S.-China trade deal or anything that happened in the last 2 days. And I think that's because a framework for a trade deal is not a trade deal.
Oh, that's absolutely true.
And I think that that's what happened yesterday to the markets. They said, wait a second, we're not actually seeing anything of substance here emerge.
Well, so you're getting at what we're hearing from traders, which is that they're not expecting anything to emerge for a while. They also can see that China is slow walking this. They also know that China knows that this could all be canceled by the courts. So moving, as you say, moving forward really requires an agreement with the U.S. and China, and we probably aren't going to see that for a long time. And that creates this situation where if you look at the way that the market has moved over the last 4 weeks, we're up about 1.4%. Mm-hmm. In the prior 4 weeks before that, we were up 12.5%. So we basically have gotten as far as we can go. And now the question becomes, do we take it over? Do we step in as an institutional investor? Do you step in and buy this? What do you do when you know that really there isn't anything there isn't anything to stop gains, but there also isn't anything to galvanize a change in the market tone?
Oh, okay. I can tell you what will change maybe market tone in just about a month. Guess what? We get JP Morgan earnings.
What? Are you seriously doing this?
No, I'm thinking.
Didn't we just get NVIDIA earnings?
We kind of just did, but I'm thinking that's going to be the next kind of gut check on things.
I think people are kind of concerned about earnings going forward. So to JP Morgan's earnings, there was some news, it wasn't yesterday, it was 2 days ago. Citi said that they are adding capital to their reserves for bad loans.
Not good.
So this is where you start getting concerned about what consumers are buying, and really it's going to be about the outlooks, because it's the second half of the year. This will be the second quarter. And so they'll be saying, okay, for the rest of the year, we're expecting whatever. And if more companies pull their outlooks, if more companies say there's all this uncertainty, we don't know, and the numbers don't come in beautifully, we could see a drop from records.
Before we get Jamie Dimon commentary, we get Jay Powell commentary.
Well said.
Next Wednesday, we hear from the Fed chair. 200 basis points cut?
Wouldn't that be a shocker?
That actually made me laugh when it hit the terminal.
You're not the only one. I was with three colleagues. All of whom our audience would know, and I will not blow up their spot, but they are all on the TV side. And we got this headline, and I said, guess what the president is calling for? And I said, 2%. And then somebody said 2 basis points. And I said, no, 200 basis points.
So the problem with that is that would actually cause a panic in the market.
It would mean the economy is falling apart, right?
Right, exactly. It means like the world is ending and we need to save everybody, get into the lifeboats, all that. The thing, though, is if you look at the numbers that have come in, you would think it's kind of, we're ready for him to say something dovish, something where, we're ready to think about cutting and everything like that. But if you heard Janet Yellen talking today, she's saying she expects the Fed to go slow and she expects inflation to rise to 3%. And that's headline on the CPI, which was 2.4. She expects the inflation to go to 3%. By the end of the year.
Because of tariffs or?
Tariffs mainly, yeah. And so if you're expecting, dovish, smooth jazz Jay to come on in and, make everything really cool, I don't necessarily know that that's the case. But yes, like that actually could. So if he came out and said, hey, listen, but we're actually in a place where we're thinking that, we're ready to start moving, and whatever he would say that would sort of set up, and then you'd have the Fed speakers coming through, setting up this, move lower, that would actually goose the market. But I don't know that we're going to hear that.
It's smooth jazz J, or it's like Waymo J, right? Like you get into a Waymo. I'm like obsessed. I'm obsessed. I know. It's like you get into a Waymo and it's like I'm in a spa.
I take full credit for this, by the way.
No, I totally give you full credit because you were all in after your ride, and then I'm like, I got to do this. I got to check it out.
You're like turning into a Californian, or like you did in Arizona though. You did in California, you did in Arizona, you did it everywhere. Everywhere you go, you get in a Waymo. That
I want to be Tim when I grow up. That's what I want to be.
We all do.
Any signs? I know, totally. 45, 50 seconds. Signs that investors, any signs that they're moving into cash or cash-like investments? Like, it's making me wonder, was it a conversation we had with you
there is.
About, like, okay, we bounce back. Maybe it's time to, I'm out.
Well, the returns on treasuries are nice. So it's not like it's a bad deal. There is some hiding out going on. What we haven't seen is there was a big pile of money that was ready for shorts that got moved in and sold.
Right.
So what we're not seeing is like just a ton of positioning against the market. What we're seeing is just sort of a wait and see mode. And then you have retail buying.
Good stuff. What was it? Slow jazz?
Smooth jazz.
Smooth jazz.
That's what we call him.
Smooth jazz Jay.
He either does smooth jazz or punk rock.
I thought he was Grateful Dead guy.
He is a Grateful Dead guy.
Yeah, not punk rock.
He is a Grateful Dead guy.
Eric, thank you so much. Eric Weiner, Senior Editor, Equities America at Bloomberg News, joining us here.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We're getting shares of RH. I almost called it Restoration Hardware.
No, that's what it was known for a long time.
Yeah, it's now called RH, right?
No, it's RH now, yeah.
Up 12% in the after hours. The company out with some headlines, out with some news. As Romaine mentioned, the way we get these numbers is really difficult because of the way that RH publishes the numbers. So we're just now getting them in. 21%, or 52% rather, of upholstered furniture will be produced in the U.S., 21% will be produced in Italy by the end of fiscal 2025. The company also reporting first quarter adjusted EPS came in at 13 cents. The estimates were for a loss of 4.6 cents. The company also saying first quarter net revenue coming in just below estimates at $814 million. Estimates are for $820 million.
Yeah, and I think what's interesting, as we mentioned kind of earlier, is that this stock has taken quite a beating this year. It's down about 55% year to date. And as I also mentioned, that almost 21% of the float is shorted. So any signs of outperformance, and we certainly saw that with the first quarter adjusted EPS number, that was a big beat, that we could see some short covering, and that is why you might see the stock bumping up in the after hours. The company also delaying the launch to spring of 2026, delaying launch to spring of 2026 due to tariffs, delaying launch of a new concept planned for the second half of 2025. They're now shifting that into the spring of 2026. So quick check on this stock in the aftermarket. It is up, Tim, about 14%. So again, that second, it looks like that outperformance certainly maybe is why we're seeing investors move into that stock. Yeah,
RHC's tariff disruption hitting revenue by about 6 points in the second quarter. We're going to bring you more updates as we do get them from RH and other companies that are continuing to report. In the meantime, I want to talk a little bit about private credit and private markets. The influx of wealthy individual investors is set to reshape private markets, bringing new risks around liquidity, transparency, and valuations to this still largely opaque industry. This according to a report published on Tuesday by Moody's Ratings. We've got with us Christina Paget, Associate Managing Director, Head of Leveraged Finance Research Analytics at Moody's Ratings. She joins us once again from New York. Christina, good to have you back with us. We've spoken to you quite a bit over the last couple of years about private credit, specifically leveraged finance. I'm wondering about the research that you and the team have done over at Moody's and what you found in terms of new risks as this market has grown.
I don't know if we've seen a dramatic change in terms of the kinds of risks that we've identified. Maybe they're just getting more dramatic. You know, we get closer to a size in which there are systemic implications. And so that becomes part of the challenge. There are some changes, though, that I would want to highlight. Some of the relationships between the direct lenders and LBOs, when they were exclusively bilateral, there were some strengths to that relationship. The tightness of the documentation for those transactions, some of that is loosening further as demand increases for assets themselves. So there's the risk on that side. And then, as we highlighted in the report, the presence of a retail investor does change some of the dynamics. Again, it probably exacerbates a liquidity issue. That we thought was balanced by long-term capital.
Christina, anytime there's like all of a sudden everyone wants to run into an asset class, it always makes me a little nervous. And I just feel like in the last year or two, the momentum behind private credit has just, the velocity and the run towards it just seems to have grown exponentially. And so it makes me nervous that money then maybe isn't as particular in terms of where it goes, because you're going to have a lot of money chasing similar assets. It drives up values, but it also then maybe puts pressure on money to go into places that aren't as beneficial, safe, secure, transparent, pick your word. So is that kind of what you guys are thinking?
Well, some of what you've just described is what we highlighted in the report. And I guess the thing I would add is that sometimes also it allows for more leverage in the system, which is obviously something as a credit analyst we are concerned with. The flip side to that is that with the expansion of private credit, we saw more liquidity enter the space broadly. And if they're really taking the risk off the bank's balance sheet and putting it in the hands of a different set of investors, that doesn't have to be an increase in risk. And if the life insurance, long-term investing is finding that there's attractive assets within private credit, that may be a safer place for those assets to be than on banks' balance sheets again. So some of this migration could be beneficial to the overall system. But you sort of take the words out of my mouth, right? When you say if there's too many investors in too short of a time pursuing these assets, we might see sort of too much asset appreciation and some poor decisions being made. I think the other thing that we tend to highlight is the concentration among, not that many large asset managers. And so those are some of the things that we highlight as concerns.
Why is that a concern? Because, you have the folks at the traditional banks that we talk about all the time. I've heard some of them say, express not disdain, but criticize private credit in the sense of, well, they don't have to deal with the same regulatory environment that we do as big banks. Is that a concern to you?
Sure, and I don't think we're shocked that, one set of competitors is criticizing a different set of competitors.
Exactly.
But we are fans of a certain kind of regulation, the kind of regulation that brings transparency to an asset class. So the banks are obliged to submit to much greater regulation, but also provide much more data, to the federal agencies. That's very instructive, and there is a limit on that same kind of transparency on the private side, and that does give us pause.
So, we think of the ratings agencies to kind of, hopefully be on top of all of this. But is it hard to be on top of everything that's going on in the private credit world? Because those investments, I don't know, like how much information can you really gather on various private credit investments? I mean, obviously, like if folks are creating the funds, if they're not doing well, investors aren't going to continue to put money into them. So in some ways, there's a checks and balance system. But I do wonder about other ways to have checks and balances on these types of investments. How do you guys do it?
Well, some assets are much more visible than others. So for example, the largest share of private credit today are the business development corps in the US. Mm-hmm. They have to value their loans every quarter. They have to provide other kind of credit metrics. Most of them are publicly traded. So there is some information there, and we rate probably the majority of them. Mm-hmm. So that has some value, but it's also up to us to take that information and put it into our own systems and make sure that, for example, everybody is valuing that loan the same way. There are other parts of private credit that we do have less insight into. It is depending on how you measure it, is how big the market itself is hard to say. There is that aspect as well. But
Christina, we
do rate the insurance company,
right?
And they give us access. So
we're going to have to leave it there. Christina Paget, Associate Managing Director, Head of Leverage, Finance Research and Analytics at Moody's Ratings.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.